we've been talking about um, how these infinite banking strategies or personal banking strategies, family banking strategies, how they work. And a lot of people, the first thing people think about is how to pay off their mortgage faster. So I got into this industry, financial services, as a debt management consultant. I learned about a debt roll-up strategy. Um, I used it to get myself out of debt. And what it was paying the same that you're currently paying and just structuring your debt a certain way to be more efficient with it. And so you, just like on a credit report, you rank your debts, the highest debt to the smallest debt, and then you pay the minimum except to the smallest debt. There's some people like, oh, you pay it to the highest interest first. I'm like, well, usually the smallest debt has the highest interest anyways, right? But there's a benefit right away that helps you when you do the smallest debt first, because you're going to pay that smallest debt. You're going to see some results. Okay. So then when you take that, when that debt's been paid off, you take that debt service amount and you add it to the principal, or you add it to the payment of the next smallest debt, the next one in line, right? Everything you pay above and beyond the minimum goes straight to principal, lowering your effective interest rate, paying everything off faster. It's called that's been called the snowball. So you create a snowball of money, rolling it up, okay? Paying everything off faster. Okay, so I got a job working for a company that claimed to get you completely out of debt, including your mortgage, in as little as 5 to 10 years without increasing your monthly payments. And they would put everybody in a debt roll-up. They would, there was equity in their home, they'd give them a second mortgage or a new first mortgage and consolidate strategic debt that would create the largest margin of savings, and then add that into the debt roll-up and incorporate consumer credit counseling and debt settlement strategies. And they can get you completely out of debt in as little as 5 to 10 years without increasing your monthly payments. And I couldn't figure out, without using the consumer credit counseling and debt settlement strategies, which will put a ding on your credit, I couldn't figure out how to get anybody out of debt in under 10 years. And then when I came to Legacy Life, or All Into Life, they're doing business as right now, the guy that recruited me because I had this understanding and because of my background in debt management and mortgages. And he kept saying, with all those people that have mortgages and debt, this is perfect for them, right? And I wasn't sure how. And so I had this idea using the synchronistic business strategy, and I got turned on to the Veterans Franchise Council, and this guy Stephen Taylor, he's a retired Navy officer, and he has like 300 some franchises that he turns people onto. And this one specific one he designs for veterans, that if you're a veteran, they'll waive the $45,000 franchise fee. So for about $20,000, you can get into a franchise, and it's installing audio-visual centers in homes and businesses, and it's like setting up flat screen TVs, right? And I figured out if you did 4 installations a day, 5 days a week, you'd have a net cash flow of $7,500 a month. And if you did one 10 by 20 LED digital wall, and I got the source for that, turn them on to them, you'd double that income. You'd be $15,000 a month. You know, doing 4 installations a day for the flat screen TVs and one 10 by 20 video wall for an event center or places that they have concerts or whatever, right? Or churches like them too, right? And you double your income. Then I'm like, yeah, what if you bought into other franchises, right? And not the same, because you don't want to be your own competition, but other businesses that support your businesses. So that's where the synchronistic business strategy came from. And when you use one of these whole life policies to do that, it's like, oh, this adds gas to the fire. All right, so what people will do, the one they talk about the most is real estate. So what people will do is they'll use this strategy to pay off their personal home. Okay. And so if they just had the mortgage debt, they didn't have other debts like a car payment or credit cards, student loans, whatever, that they could implement this strategy with, it would happen even faster. But just if they had the mortgage. So if you had a $250,000 house or mortgage at 7.5% interest, I know rates a little higher now, they're at 8 something right now, but it's 7.5%, just because I have these numbers memorized, then you would be able to, your payment would be $1,748.04 a month. And if you add that into your policy. So my son just so happens to have a $250,000 policy. Okay, now he didn't have a whole life policy. He has an index universal life. Okay. But if I would have got him a whole life policy, he could put the money, overfund his policy. So let's say he pays $2,000 a month. That would cover his target premium, and it would cover the debt service on his $250,000 mortgage at 7.5%. And he borrows the money out of the policy every month. On the first of the month, pays his mortgage. All right, now I'm like, how does that pay it off faster? I understand that you're taking the same dollar that's going into the policy and earning interest to pay off your mortgage, right? So now you're knocking down that mortgage, you're paying off that mortgage, but you're also gaining in your policy, earning that 5% on that money. Okay, now it doesn't accrue because he's paying the same every month, so he's going to pay that loan gets paid off every month, so it doesn't accrue interest. All right. Well, then I looked at an example. All right, and at year 9, month 2, he would have enough money in that policy to pay off the remaining balance of his mortgage. So he would borrow the money out of the policy, pay off the mortgage. Now he's paying himself back. He's literally become his own bank. Right? He's paying and just paying the same he's paying. And he's racking up a significant savings. Now, what people will do is they'll get another loan against their house. It's a secured debt. It's their primary residence. The rate's going to be cheaper, right? And they'll buy more properties, probably a multi-unit, like a 4-unit property. All right. Now they're using the same strategy, putting enough money that's covered by his tenants. His tenants are paying their rent, and that goes into the policy, and then he pays out of the policy, pays off the new mortgage on his house that he used to buy the multi-unit property, and he's paying that mortgage on the multi-unit property. But that amount of money is getting stacked up in his policy. Okay. And I'm like, oh, this is interesting. Okay. And then he can do it again and again and again. And, I was listening to a guy on a podcast talking about he's a business consultant. And he buys businesses, increases their revenues significantly, double to quadruple, and then sells his interest, and then put the money back in his policy and goes looking for another one. All right, but then I learned I'm trying to make this happen. I'm like, let's look at a $4 million policy and funding that policy, doing this Quick Mount Heroes Initiative veteran franchise where your $20,000 gets you a franchise, right? And making this kind of money, making $15,000 a month on each franchise, saving that money. Okay, so and you buying more franchises, right? It'd be smart. This is why start implementing the synchronistic business strategy. Okay, so talking to a young guy who started working in a jewelry store, right? And talking about partnering with a somebody who does cinematography and photography, because all these wedding receptions and quinceañeras, they need those people, right? Partnering with a event center, that they have quinceañeras and wedding receptions, right? And they need the photographers, right? And then, we said, I thought this would be really good. This would work well, right? And then, this would be a good, the guy has a background in video production. Yeah, you could do that. But do that, you make that your part-time gig, right? So when I did this illustration, I did this spreadsheet showing starting a part-time, starting a job with $15 an hour, warehouse job, retail, how you would, and then at 3 months into it, start your part-time gig, making half of what you're making on the $15 job. So let's say you're making $7.50 an hour, whatever, on your part-time gig, your side gig, and then every quarter it's increasing 25%. That by the end of a year, you'd have enough to buy another $20,000, to buy another franchise. And then I started thinking about these franchises that support, businesses that support each other. Okay, talking to a guy at church, came from Hollywood, working in production. Well, he knew a guy who was a producer, didn't make all his money doing videos. He made all his money with his energy drink, doing all these cool videos, skydiving and snowboarding and motorcycle races, right? And rock climbing, whatever, right? And I'm like, oh, wow. So it got me thinking about the MMA and boxing production, right? I'm like, oh, this is ideal scenario, right? And so these are just, so with what Jason Cisneros does, I'll be on the podcast tomorrow morning at 8 o'clock with him on X, right? He's talking about, he talks about businesses that are going from, he wants to take them from a $300,000 a year income to up to $750,000, right? And he says, he doesn't think about saving the money until they reach that $300,000. I'm like, no, you don't have to wait. These strategies, I can help somebody starting from nothing. Okay, getting that $15 an hour job, starting a part-time gig, saving up your, an emergency fund, and then get you into, in with a convertible term policy where the premium's really low, but you got that, it's the potential to become bigger when you convert it, when you have your emergency fund, 3 months income in reserve, and then now you take that money you put in the emergency fund and you start funding your policy, okay, and then using it using that using it to pay off your debt is actually taking the same dollars you're paying towards your debt is going to go into the savings into the policy. Right. So here I am talking to somebody, the guy that got me involved in financial services. All right. And he hit me up with, yes, well, my dad had a whole life policy, and should have been a $400,000 policy, but it ended up only being $100,000 to my mom when she died. Why was that? Well, because he stopped paying at age 72. Right? So now that cash value in the policy was paying that premium, because the whole life, you pay premiums your whole life, right? And if you have enough money in the policy where the interest from the policy pays the premium for you, okay? So after a while, right, when you've done this long enough, it starts knocking down the principal to cover the premium, right? And that gets into how you structure these policies. And this is the key, and which got me excited. Okay, you want to have as little insurance as possible with the most amount of cash. And I ask providers all the time to do this for me but use an index universal life. Well, index universal life, you do not get a return on your borrowed money. Only in a whole life. Okay? Now, when you overfund these whole life policies enough, okay, then they'll keep that insurance, keep you insured for your whole life, but that cash value is going to come down, right? And if it comes down too far, so does the death benefit come down, okay? Because what they're doing, it's a increasing death benefit, okay? So you have a certain amount of insurance, and then you build up the cash value, then the insurance plus the cash value, that's the death benefit, okay? So that's what happens, okay? You can have when you're young and healthy, you can have a lower amount of life insurance, but you keep paying into it, okay? And if you do these strategies correctly, this synchronistic business strategy, you will pay it out. But here's the kicker that got my attention. You can really max fund these policies with a low amount of insurance when you have these term riders, because the term rider, which is inexpensive, gets you, because of the amount of insurance, keeps you becoming a modified endowment contract or a MEC. Okay, so that means you can sock more money into it because of the term rider. So you can get a little bit amount of permanent insurance, whole life, tack on a term rider for $1 million or more, right? And now you just got a bigger bucket of money, and you just keep filling that policy. Okay, and after a certain amount of time, when you got a couple $1 million in the policy, you can drop that term. So now your money's even growing more because you don't have that expense at the term, because you don't need it because you have enough cash in your policy. Okay, so this it's like this is not your dad's whole life, right? It's a new animal. There's different ways they structure it. 50-50. I've done 50-50 quite a bit, and what that does is it brings down the cost of insurance, so somebody can't come behind you and replace your policy, and they don't want to, because it's going to cut into their commission. I don't make as much money on an individual policy by doing it this way, but I'll do more of them. Okay, when somebody looks at, you can do a 60-40 or 90-10, only 10% of the coverage is the whole life. The rest of it is term, which is less expensive, but you can sock more money into that policy because of that higher amount of term rider, and it prevents you from becoming a mech. Okay, you just sock money into it. Right, that's the magic of it. Then of course you can borrow against a policy in for a franchise or real estate or other ventures. This whole thing ties together. Whole thing comes together, and you don't got to wait till you got $300,000 or in your business to start saving the money this way. Okay, this is the way you do it. Okay, so I'm gonna, hear that, Jason Cisneros? I can help anybody, right? But this is exciting, how this all works together, right? I have fun talking to somebody like, what do you do now? What kind of business would you want to start? Okay, and here's another thing. Because people don't know this and understand this, I got people in the industry I know, right, that they have no clue about how to structure these things. I have to have somebody help me. I haven't done it enough, so I know how to do it myself yet. Okay, and the providers don't really understand how to help you either. I got one guy that understands, okay, with one of my providers. Right, so these are, I have to have somebody who's been doing it for a bit help me out. Right, I get the information, they compile the information, and or put it together they structure it in the plan, and then we present it. Okay, and it won't take me very long till I can do that. But it's a new. I understand the blended policies, the different ratios of blend, is something I'm just learning about. Okay, but the understanding that small amount of whole life with the additional term rider, it takes that by term and invested difference to another level, because there's no mutual fund, there's no individual stock, there's no bond, all right, that you can do this with. You can't borrow that money and still collect interest on that amount of borrowed money in the policy or in whatever the investment is. You can't do it out of your 401k. If you borrow from it, you don't get a return on it until you pay it back. Okay, in a whole life policy, that's what they do. That's what you can do. I hope this is clear. I hope people get to understand this. I wish I would have had Tom on. He comes from he was with A.L. Williams back in the very beginning. And, that's that by term invested difference. And that's what happened. They demonized whole life. They demonized cash value, call it trash value life insurance. And and they just don't understand. They don't understand. They didn't know enough on how to structure right. And most people that are in the industry don't anyways. People that are selling whole life, most of the time don't understand this stuff. Most of the time they're just order takers. They get with somebody that somebody goes online and they want a quote for life insurance, right? And they try to sell the the cheapest amount possible, so they give them term, right? And you only get a return on term if you die, right? And they're not showing these strategies. This is an advanced technique in finance, but it's not that hard, right? You just have to understand the chassis of the whole life and how by adding these riders, these term riders, that you're reducing the cost and allowing your cash value to grow more, because you're not paying out so much for a cost insurance. I tried to do this illustration showing this synergistic business strategy, right, with a $4 million policy. My cost of insurance was too much. Okay, because I had a $4 million whole life, and I was trying to do it indexed first life. Then I learned that you can't you don't get a rate of return on that borrowed money. It looks good if you pay it back. Okay, but in these whole life policies, you don't have to pay them back. I mean, you are paying it back by paying your premium. Okay, and that's how that works. But you can, you want to make hay with that money. You want to make that money, put that money in a business that produces for you that is enough to pay for the policy. All right. Well, we usually do longer than this because I have Tom talking, but he didn't come on today. But I'll send him this. He's always on. And anybody wants to come on, he's going to do it every Friday, 8 o'clock Central Time. And we're going to talk about, the synchronistic business strategy. Oh, yeah. Go to mybusinessisyourbusiness.info. That's my website. And I have the different have the little you got Be Your Own Bank, Family Banking Strategies, Synchronistic Banking Strategies for Business. There's videos in there, and then you go down and you'll see Jason Cisneros, his Built to Exit podcast. I'm waiting for him to give me the banner, his banner, so I can change it. But it's Jason Cisneros. Link to his website. Then there's the Gusto. Okay, they do business administration or payroll and HSA administration. And then there's the Quick Mount Heroes Initiative, and right next to that have the Boots to Business SBA grant. Okay, so it's $50,000 grant or loan, $50,000 SBA loan to start business. Okay, right next to that. Okay, so check that out. All right, there is a grant though that'll help you with that. That's how I was looking at grants. Somebody asked me to look at grants for this area, and I stumbled on that. But I put that on the My Business Is Your Business .info website. All right. Well, doggone it, Tom didn't come on. I was waiting for him. All right. He'll hear me talking about him here. He'll come on next time, I'm sure. All right. And then we'll talk about this. I'll send this to him, and we'll talk about it. All right. Well, have a great weekend, and then I'll be posting this video on the podcast. All right. Have a great